If you are a price action trader, then I'm pretty sure you are making at least one of these three costly mistakes. And these three costly mistakes might be the difference between being a consistently profitable trader versus a trader who is still struggling. You see, trading price action requires a lot of experience. Set the wrong take profit target and you see your paper profits vanish. Set the wrong stop loss placement and the market hits your stop loss before going in your predicted direction. Try to nail the perfect entry and you end up missing the trade entirely. Worse still, if you chase the trade and end up getting in when the market is about to turn. In this video, I will cover the three costly price action trading mistakes that many retail traders make. The goal of this video is to bring to your awareness what you might be doing wrongly first. Then as always, I want to give you practical solutions that you can do to avoid making these mistakes in the future. After all, there's no point telling you what's wrong and not providing you any solution. So I hope you watch this video till the end, and more importantly, actually implement the concepts in this video. Sounds good? Please hit that thumbs up button and subscribe to the channel. It helps this channel grow and my team wants to keep serving you at the highest level possible. So I would really appreciate if you could support this channel. We also do a giveaway for our plug and play trading package worth $37. If you want to participate, look for an emoji somewhere in this video. You can also find the full instructions in the pinned comments down below. Now moving on, let's talk about the first costly mistake. And that is setting an unrealistic profit target. So you heard all about the risk to reward and how capturing the best reward to risk trades is the key to growing your trading account. Well, that's correct, and in this channel I always emphasize that with a good risk to reward ratio, you can be wrong half the time and still make money. But here's the part where many traders trip up. They take that advice and implement it wrongly. So what they do is look for a trade setup, and because they are so eager to trade and want to take a trade, they input a crazy take profit that is very far away. And this crazy take profit level is often a level that is random and not backed by any logical analysis. Put it simply, they are trying to artificially alter the risk to reward to convince themselves that this is a good trade. After all, some educator told him that getting an excellent risk to reward trade is the key to making money, isn't it? Now, what about the immediate resistance level over here? Would the risk to reward still be that attractive if they were more objective in their analysis? Well, the solution to this mistake is rather straightforward. Be objective in your analysis. If you realize that you tend to set unrealistic targets, then you should plot all your key levels before looking for an entry. By plotting out the key levels even before deciding what you want to do, you will be less likely to randomly pull out an imaginary take profit level once you do decide to take a position. Now, I want to move on to the second mistake, which probably caused traders a lot of pain. So if you want to avoid losing money, then stick around. Because this second price action mistake has to do with poor stop loss placement. And there are two major mistakes that rookie traders make when placing their stop loss. The first is using too tight a stop loss. You see, having a stop loss is a double-edged sword. Yes, you should input one because it helps limit your loss if you are wrong. But on the contrary, what happens if the price happens to trigger your stop loss and then go in your intended direction? I often hear traders complain that this is actually more painful than losing money and being wrong. And well, it should be, because think of it, you lost money even though you were right about the direction. So setting in a stop loss too tight is the first mistake. Well, the second is the opposite, and that's using too wide a stop loss. Now you probably understand why poor stop loss placement is such a costly mistake. Set it too tight and you lose money. Set it too wide and your risk to reward will be very poor. Suppose you set in a stop loss of 100 pips in this chart over here. If you want to catch a big reward to risk trade of 4:1, then price has to move 400 pips just for you to hit your target. Oh, and not to mention that you might make the first mistake I talked about previously, which is setting the take profit at an unrealistic level. But hey, that's not the worst part. The worst part happens when a trader doesn't know how to apply adaptive position sizing and reduces position size since the trade has a bigger stop loss. So what happens? Well, it results in a big loss. Imagine what happens if a trader typically trades one lot and applies the same lot sizing for all of his trades. The first trade is a 30 pips stop loss and he earns 30 pips back. Pretty okay. Now, his second trade has a big stop loss of 150 pips, and because he doesn't understand how to size his positions, he goes in with the same one lot. And boom, the trade is a loss and he has just lost $1,337. Do you see how dangerous this is? So what's the solution? How do you set your stop loss at the sweet spot? Well, you can use an indicator like the average true range indicator to set your stop loss. The average true range indicator accounts for the volatility of the instrument you are trading. Basically, you can set in stop loss of 1 ATR below the support or above the resistance level. I won't go into the full details in this video because I've already uploaded a video about using the average true range indicator to set your stop loss quite some time back. So if this is something you need more information on, then I will leave a link to that video on the top right and at the end screen of this video. So let's move on to the last price action mistake, which is one that will probably shock you. And that is focusing too much on nailing the perfect entry. Here's the thing, your exit actually matters more than your entry, and yet people spend more time focusing on nailing their entry rather than planning how they will exit. Let me explain why your exit is actually more important. Now, you can always compensate for a bad entry by managing your position size and setting in a wider stop loss. But well, you can't compensate for an bad exit. Suppose you take a trade and the market goes your way, and because you are greedy and refuse to lock in your profits, the market comes back and you're left with nothing. Now, in this scenario, there is nothing you can do. You are at the mercy of the market. Now, contrast this with a bad entry. Perhaps because you were too anxious to get in? Well, you can always remedy this situation by entering a smaller position. Another important pointer worth mentioning is that trying to nail the perfect entry might actually be costing you more money than you think. Why? Well, because by trying to be too perfect with your entries, you might end up missing opportunities. Let me show you an example to illustrate what I mean. So over here, suppose that you were waiting for the perfect entry around here, and price almost reached the level and misses your level. And because you were taught to be patient and wait at your level, you wait. Well, price takes off without you, and lo and behold, the trade just had to be a big winner and you caught nothing. I'm sure you can relate to this because you will probably encounter this at some point in your trading journey, and it will happen over and over again. In fact, as a professional trader, I still encounter this problem till date, but I do recognize that there isn't a perfect entry and take certain steps to minimize this problem. So what's the solution? Well, the solution is rather straightforward as always. It is to consider the risk to reward. So long as the risk to reward is decent, then go ahead to take the trade. You don't need price to hit the level exactly. Somewhere close to your key level will do the job. But please do not take this advice out of context and start entering early because you are impatient. Look at the risk to reward. And if you are able to get a minimum risk to reward of 1:1.5, then go ahead to take the trade. And make sure to have an exit plan because that's more important than your entry. So here's a quick summary of the 3 costly price action trading mistakes that most retail traders make. Number 1, setting an unrealistic profit target. Number 2, poor stop loss placement. Number 3, focusing too much on nailing the perfect entry. There's a very high chance that you are making one of these mistakes if you are still struggling to turn a profit. So make sure to implement the solutions that I've recommended to fix these mistakes. And that's all I have for you in this video. I hope you got value. As promised, I will drop the link to the average true range indicator video over here. And if you want to learn how to place your stop loss better, then this video will show you how. Thanks for watching and make sure to subscribe to the channel. See you in the next one.